Hello, today is Saturday, July 11th, 2020. Can a rotation into the have-nots push us higher? Hey, I'm Jonathan Gurney, Portfolio Manager at Gurney Financial. The purpose of these videos is to educate and keep clients aware of what is happening in the stock market. Our goal is to close the gap in communication between clients and the actual person managing their assets. We use a combination of fundamentals and technicals as part of our analysis. We hope the charts and education help clients and viewers alike. A friendly reminder that this video is not to be used as financial advice. Should you have questions, feel free to reach out to us. If you have questions about our philosophy, check out our FAQ section at gurneyfinancial.com. We're going to hit the charts. First of all, let's do a quick rundown on performances. Another great week. We are a little bit cautious in how we are allocated. But for example, the Asher, which is a ticker for China, was up 10.6% in a 5-day period. So we're running a little hot in many areas. The TAN, a solar ETF, was up 10.79%. We were in that and sold on Thursday. Emerging markets was up within the 5-day period of 4.55%, sold into that. S&P 500 for the week, 1.7% higher. The Dow up 1%. Russell still struggling, down 0.7, but saw some life on Friday. QQQ was up 4.7%, still crazy performance there. A little overbought, I think everybody can agree. It doesn't mean it ends there, but it's something to pay attention to. Interesting enough, despite a good week, the TLT ended up 1.7% higher, and the gold also ended up higher. Gold and silver had a great week as well. So we're going to transition to the charts and go from there. Okay, here's the S&P 500. We want to do a quick macro review. So the yellow is basically a 2-year period where we have been trading in a tight range. Yes, we did get out of it, but we thought we might trade in this range for quite some time. But I do question whether we still trade in a range more in the red range between 20 or 32, 33, and maybe 2,900. We want to be real in saying it would not be uncommon for us to see a 5 to 6% dip from here. It doesn't mean it's going to happen right away. I mean, we're actually seeing very good price action. We want to be real about that. But there is a huge divergence between stocks in the NASDAQ and stocks in like the Russell 2000. So could we get a rotation to some of the have-nots? And what I mean by that is during a COVID crisis, there are haves and have-nots. My trading group with Christian Frommerts, we definitely hit that hard and to say, hey, if there's any good news on the earnings front or just any good news in general, we are going to get a pump into likely the financials, the casinos, airlines, travel stocks. And that's kind of what happened Friday. We got some good news on a treatment. Again, it was a treatment. It was not a vaccine. Big difference there, but the market took that as bullish. Many of the NASDAQ names still did okay, but many of the leaders, momentum names, actually did not really do that great yesterday. So the S&P 500 in short is the red range that I think we could be trading for quite some time. It's going to be a frustrating period in my opinion. Again, these are my thoughts. It doesn't mean it's going to happen. We're going to follow price action regardless, but it would not be uncommon from this point to see a 5 to 6% dip, get to the 3,000, the 2,950, which would be really close to the 61 retracement on the Fibonacci if you're a believer in that philosophy. Again, a couple weeks ago, we said, hey, it would be good to stay above an RSI of 50. That happened, and it's been good price action. I do think the QQQ is overbought, and many of the momentum names are overbought. We have a few in there still. We did sell a lot of the high flyers in TAN, EEM, MSCI. There's one more in there that was sold, CrowdStrike. It's not that we're bearish on the names. It's just, hey, they've run 20 to 30% since we bought them. Take the gain in this environment. That's kind of where we stand. So even keeled, it's important to remain even keeled in this period because really, you got to remember in June, we are actually still below where we were in June. So even though there's a lot of volatility and it's up and down, and Thursday we thought the world might end at that point, price action still is hanging in there. So follow the trend, but also be realistic in taking gains. Like, could we see a rotation? This gap right here is the range we've been talking about for quite some time, and we're going to show that to you. 3150 to basically 3180, or 3155 to 3185 was a gap that we're saying it's going to be difficult to get out of here. Now, Friday we closed at top of range. This is a very key level. We're heading into earnings season. So the 16th is really when a lot of the banks start kicking off. I don't have a crystal ball, so I have no idea what that looks like. I can tell you I did start to trim positions into the weekend, maybe even a little prematurely, but I'm okay with that because of some of the things I'm about to show you. Because really, we want to be in a lot of momentum names, and many of those areas are overbought. Doesn't mean we don't get a rotation into some of the have-nots. Again, the financials. Have-nots is basically a terminology for the period we're in right now with COVID. Like, you don't want to own financials if case count is increasing. It's not going to be good for financials. It's not going to be good for travel stocks. But if things improve, they will get a bid. So really, the opportunity is there, but is it a good risk reward? That's what I continue to ask myself. So we are trimming into this rally. I'm not saying there's not opportunities. There are opportunities. I want to make that very clear, but this is a range we've been talking about for quite some time. We've been testing this in and out, and we've failed many times. Would it surprise you to see before earnings a little rally? It wouldn't. But again, I question risk reward. You know, we might go up 1 to 2% higher within the indexes, but is that worth the risk of what could be to the downside? That's where we're struggling a little bit, to be honest with you, and why we continue to have some on, but are trimming some of the high flyers. So put call ratio, getting into more the breadth. Hold on a second. The internet is struggling a little bit. 1 second. While this is doing this, actually, hold on a second. Internet is really struggling. There we go. Put call ratio. Sorry about that. So within the week, we saw a couple tests in the 40 range. Okay. And to me, that's a red flag. It's not an immediate sell, but to see some complacency when things are this high, that does concern me. So you can see, like, I keep some on that I think could do well in this environment, and some I do take off and say, hey, I got to take a 30% gain here. So right now we're at 46. It's not horrible. Again, the yellow range is kind of where I'm like, hey, be cautious here. So that's where the put call ratio is. So indicating some complacency, but just got to be careful. It's not an immediate sell. Did see some good things in the VIX this week. There were some tests. We got above 30 even Thursday. We opened on Friday above 30. Big down move of 6.7% down to 27. So this is good price action. I still don't think we get out of this range for a while. I think it's going to take some time, but good things to see there. We got to be real about that. This is crazy. Value versus growth. Value versus growth. You can see this ratio is some of the lowest we've seen in a long, long time, meaning growth names are what has worked, and they probably will continue to work. I'm not saying that, but it would not surprise me to see value if case counts increase or decrease. We're seeing some good things in some areas. Like, really, in my mind, if case count increases and deaths increase in New York, there's going to be a problem. Okay, I'm not trying to scare anyone, but things are so high, it doesn't take much for things to shift. But if case count decrease and deaths decrease as well in some of these areas that are increasing, you're gonna see probably a push to some of these value names. So I'm just kind of showing you some breadth stats there. Percentage of stocks above its 200-day moving average, just to kind of show you, again, this is kind of, it's not just 5 stocks that have moved us higher, but there is certainly a strong push to a few areas, and the NASDAQ is definitely one of them. Boy, this is really struggling. I'm sorry about this. So this is the S&P 500 200-day moving average, percentage of stocks above the 200-day moving average, 41.88 versus the NASDAQ of 73. So you can see the NASDAQ is definitely performing a lot better, and that's where most of the rally has come from. And the New York Stock Exchange in general is at 32. So 73 versus 32. So breadth is really not that strong in every area. And so it's been very lopsided. We got to be real about that. The way I take that is we either need to see a rotation, and I think we get it, but can it last long going into earnings season? I don't have the answer there, but I'm not in love with the risk reward that I see here. There are still opportunities, but you just got to be careful and not get too greedy. That's the way I am trading this environment. McClellan summation, again, basically a breadth indicator based on net advances. So advancing issues, less declining issues. We are seeing a little bit of a decline here. So something to keep an eye on. It doesn't mean it doesn't snap back. It could happen in the next couple days. But zero in general, above zero is a positive trend, which is good. But this going down does concern me a little bit. Doesn't mean it can't shift, but it's something to keep an eye on. Two ETFs that are interesting. Again, we're not publicizing these. We're just saying these are areas. It's interesting. A lot of the names that we were in were within these ETFs. And on a Friday, it's interesting that since the bottom, it's up 104. This is approximately 148.9%. That's an ETF. So we are in a lot of these names and have been trimming along the way. Was I surprised it went this high? Absolutely. And we have not done perfectly on the way up. We did really well on the way down, not perfectly on the way up, been taking gains and very cautious on the way up. So underperforming on the way up, candid with you there, but definitely overperformed or outperformed on the way up. So another ETF that we're watching that was, again, momentum names did not really do well yesterday. But does it surprise you after 100% gain over 3 to 4 months? I mean, we need some breathers. Now, it's basically, if you're looking at duration of these moves, you go up a little bit, you test a 20-day moving average. You go up a little bit, test it. Would it surprise you to get a breather to the 20-day moving average or even something more to the 50-day moving average? I don't think that's out of the realm. People are overly bearish in this environment, which I think keeps a lot of people in, but you just got to be careful, okay? So that's all I'm going to say. I'll show you some of the holdings in, if it'll bring it up. So like Zoom, SE, DocuSign. So a lot of these names that we are in and out of throughout the day are where we want to be, and we're just getting a little bit overpriced here. I shouldn't even say it. We are overpriced here. Just be careful. It doesn't mean there's not opportunity. Just take gains while you have them. So sentiment trader, some good stuff here. It definitely points to just a little more caution in what I'm seeing. China's explosive rally pushed China fear index to the highest level in years. Just got to be careful. This is what I'm saying. Doesn't mean it can't go higher, but is the risk to reward great? Extreme breadth readings in emerging markets. Again, we sold Thursday. This rally is all tech. I wouldn't go that far, but this points out stocks above their 200-day moving average. We just showed you that. So another interesting point by Andrew, credit where credit is due. NASDAQ 100 is back to having over 60% of its stock showing a bearish momentum divergence, showing we are due for a little bit of a dip in this area. Now, it's good price action if value names, that beaten down names, get a rotation. And that could keep the whole index, the S&P 500, afloat. And that could very well happen. So be mindful. Don't get too bearish here, because there's a lot of things that could happen here. Like if we get a vaccine news, don't be surprised if this all goes higher. But right now, I think you got to be really careful going into earnings season. So that's where we stand. The game plan from here is to take it day by day. Would it surprise me to see Monday and Tuesday go up before earnings? Not really, to be honest with you. I'm just not in love with the risk reward. So we will continue to play the game while it lasts. I don't think it lasts too much longer, but follow the trend. The trend is currently up. So very interesting stuff. Thank you so much for your time. We appreciate all the follows and everything from clients. Thank you for being patient during a 3-month period where we have underperformed. I mean, we're making money, but we have underperformed just by being a little cautious because we had done well on the downside. So just being candid with you, we do not win them all, but we are taking winners as they come, and I think in this environment you need to. So thanks again. Have a great rest of the day, and let us know if you have questions. Subscribe, please, and check out our website, gurneyfinancial.com. Have a great weekend. See ya.